Hello everyone. Let's start new topic, valuation and yield measures of money market instrument. Till now we have already covered valuation and yield measures of fixed, floating rate and bonds with embedded option. So now new thing, money market instruments. How it is different from normal bond? The definition will clear the difference. What is the definition? Money market securities and bonds both are debt securities. The difference is if at the issuance, जब हमने bond को issue किया, the original maturity at the time of issuance is less than equals to 1 year, less than equals to 1 year. These type of debt instrument are treated as money market security. And if the original maturity, that is maturity at the term to maturity at the time of issuance is greater than 1 year, then these bonds, these securities, debt securities are treated as bonds or capital market securities. And this definition creates a big difference in the valuation and yield calculation. Because जहां आपका maturity period less than 1 year है, वहां पे हम लोग simple interest use करने वाले. We are going to use simple interest. What is the concept of simple interest? Interest is equals to principal into rate into time. और जहां पे tenure more than 1 year का है, वहां पे there will be a compounding effect. That's why हम लोग क्या यूज करेंगे? हम लोग कंपाउंड इंटरेस्ट का फॉर्मूला यूज करेंगे, विच इज ए इक्वल्स टू पी 1 प्लस आर टू द पावर टी. तो ये दोनों चीजें जो फॉर्मूले हमने देखे हैं, ये बिल्कुल डिफरेंट इंपैक्ट ले आएंगे वैल्यूएशन पे भी और यील्ड पे भी. एक और बड़ा इंपैक्ट ये आएगा कि सिंस बॉन्ड में कूपन फ्रीक्वेंसी फिक्स्ड है, इट कैन बी एनुअल, इट कैन बी सेमी एनुअल, इट कैन बी क्वार्टरली. Because of that, periodicity भी fix हो गई. So in case of annual, you will get one coupon every 12 months. So in case of annual, you will get one coupon every 12 months. So in 12 months, one coupon will be there every 12 months. So you will get one as periodicity. It's better explained with semi-annual. So in semi-annual, the year is of 12 months. And one semi-annual is of 6 months. So how many semi-annuals will be there? There will be 2 semi-annuals. So you will get 2 time cash flow and it becomes the periodicity. In case of quarter, it is 12 months and every quarter has a 3 months. So there will be 4 quarters. So it has a periodicity of 4. So there is a fixed defined periodicity in case of bonds. And this periodicity is used for annualizing the yield. Of course, in case of money markets instrument also, we will be annualizing the yield. We will be annualizing the yield. In both the cases, yield will be annualized. Whether the payment is on quarter or a semi-annual or a month or a yearly basis. Yield will be always quoted as a annual yield. But in calculation of yield, in money market instrument, they will use simple interest concept, whereas in case of bond, they will use compounding effect, that is compound interest concept. And this standard periodicity of 1, 2 in case of semi-annual, 4 in case of quarter and 12 in case of monthly. In case of money market security, this is a problem because few securities are of 3 days, 7 days, 14 days, 30 days, 60 days, 90 days, 91 day, 180 day. Different securities will have different tenure. Different securities will have different tenure. There will be one-time investment, one-time redemption or maturity will be there. How to calculate periodicity in that case? So, since the tenure is of less than 1 year, we have to go for days calculation. So again, if a bond is of 90 days and if you are following 360 days as day count convention, so this 90 day, how many times this 90 day rotation can be done? It is 360 divided by 90, so the periodicity is 4. But if it is a 91 day bond, 91 day T-bill, money market instrument, then the periodicity will be 360 divided by 91. How many times the money can be utilized? How many periods are there of 91 days in a total year of 360 days? Because we have to annualize. What is the use of this periodicity of 2? when you have calculated yield for a semi-annual bond through our calculation mathematics and R comes as 5%, what we say the annualized yield is 5 multiplied by 2, 10% per annum. So this periodicity is used for multiplying with that R, that yield what we have calculated from the mathematics, and to give the purpose is to give the annualized yield. So periodicity is going to be multiplied with your yield calculated from the formula mathematics. How many period of this tenure will be there in 1 year? So if the T-bill is of 91 days, how many periodicity will be there? In case of 360, it is 360 divided by 91. How many periods of 91 are there in this 360 days year? That number will be multiplied with that rate to give the annualized return. And in case of 360, now this is a second problem, whether we should use 360 or 365. In case of bonds, fixed rate bonds, we were using street convention, that is 30 by 360, or in case of government equivalent yield, it was actual on actual. In case of floating rate bonds, though in practice it is actual on 360 or actual on 365, but in formula we have used 30 by 360 to simplify the calculation. Again, in case of money market securities also, this is the day count convention. You can use 360 as a total number of days in a year, or 365 also. And every instrument is going to have its own maturity period, some 90, some 91, and accordingly the periodicity will be different for each instrument. So different time to maturity have different periodicities. This we will understand more with the number calculation. Next, in case of bonds, standard TVM equation is used of discounting and compounding, but here, since there is no TVM discounting and compounding, we have to use simple interest based sum equation, mathematical pricing equation. And now the simple interest based mathematical pricing equation can be also with the two different assumptions, that this interest is calculated on the redemption value, maturity value, or the interest is calculated on the principal value. These are the two concepts of pricing equation of money market instrument. Let's start with the pricing equation of the money market instrument. Very small topic, but for sure we will get a question in the exam, and there are different type of mathematical question we can get. So pricing equation of money market instrument. The first method is discount rate, second method is called as add-on rate. What is the difference between discount rate and add-on rate? In case of discount rate, when the yield is quoted in the form of discount rate, it is the return which investor is expecting on the maturity value. That maturity value should include this much of interest as a percentage of face value itself, maturity value only. Whereas in case of add-on rate, the interest is calculated on the investment value. So if I take a reference of 100 rupees, in case of 5% is the, let's say, quoted rate. So in case of discount rate, 100 will be your face value, future value, maturity value, and 95 is your principal value. Whereas in case of add-on rate, it is the 100 is the principal value, and on which you will add 5 rupees as return, and the maturity will be 105. So here it is 100, 95 plus 5 is equals to 100, and in this case it is 100 plus 5 equals to 105. This is your present value, this is your return, and this is your face value or the maturity value. In this case, this is your present value, this is return, and this is your maturity value. The difference is what is the base on which interest is calculated. So in case of discount rate, interest is calculated on the face value, which is your maturity value. And in case of add-on rate, interest is calculated on the present value, which is your investment value. we are what investment we are doing on T0. And this create complete difference in the calculation, because if the interest is calculated on face value or the maturity value, this 5 is a percentage of your face value, and in this case this 5 add-on rate, in this case the 5% is a percentage of your present value. So this creates, and we are going to use simple interest formula also. So, and further, what day count convention we will be using? Again, the day count convention can be 360 or 365 depending on what information question is saying. That we have to take care. So in first case, in case of discount rate, your present value is equals to future value minus future value into discount rate multiplied by days upon year. Year may be 360 or 365. This creates a formula FB equals to 1 minus DR into days upon year. And this is the formula we are having here. PV equals to FV multiplied by 1 minus DR into days upon year. Whereas in case of add-on rate, what will happen? Add-on rate will give the present value is 100. So future value we need to calculate. So future value will be PV plus PV multiplied by add-on rate multiplied by days into year. In this case, 100 minus 5 is 95, whereas in add-on rate, 100 plus 5 is 105. So here it is known, and this is question mark. In this case, add-on rate, 100 is known, FB is question mark. So what will be the formula? We can take PV equals to PV 1 plus add-on rate into days upon year. And these formulas will be further utilized. So first case, discount rate, let's use this formula. Discount rate will have, discount rate is present value is equals to FP multiplied by 1 minus DR into days by 100. Next, second formula. If I want to calculate DR, change the sides of the data. So FV will go into the denominator. It will become PV upon FV. Change the side 1 minus. So all the valuation calculation will be done as, so 1 minus DR into days upon year is equals to PV upon FV. DR negative into D upon Y will go into the right side, and 1 minus PV will come, PV upon FV will come in the left side, and then the days upon year will also change the side, so it will become year upon days. So we got this formula now of DR, how to calculate discount rate. So if present value and future value both are given, we can calculate what yield this money market instrument is giving. And then this is already annualized. Why? Because we have already multiplied with year upon days. So that effect of periodicity is already there in this formula. Year upon days automatically give 360 upon 90, or how many periods are there. Because this formula is giving FP minus PV, the return over the FB. So this is the return in percentage for one tenure, one period, 90 days or 91 days, whatever is the term to maturity of that instrument. And when you multiply it with your year upon days, that it means you have annualized it by assuming that if it is a 90 days and a 360 days of complete year, 4 times the same return will be generated. So you have multiplied it with 4 times. Next, your DR again. So this formula I have already written. So effectively this year upon days represent the periodicity of money market instrument. This year upon days represent the money market instrument periodicity. In case of second add-on rate, how PV will be calculated. Now this is the formula for FB, and PV is in this right side with a multiplication. So if you want to calculate PV, so this whole bracket will go into the denominator, that 1 plus AOR into DY will go into the denominator. Now, if you want to calculate AOR, again shifting the data, we will get AOR equals to FV upon PV minus 1 multiplied by again year upon days. We have done the periodicity impact. We have taken the periodicity impact. So annualization is already done. And the same way, this is your return over FV, the maturity value. And this is your return over investment value. Two different ways of thinking. That return is calculated on investment and it is add-on rate, and if it is calculated on the maturity value, it is the discount rate. Both formula have a periodicity of year upon days, which we have already seen. Now, one thing from MCQ point of view, which data is going to understate the return for investor or understate the cost of borrowing for issuer, whoever is issuing this money market instrument? It is the DR. Why? Because in case of DR, the return is divided by your maturity value. Return is divided by your maturity value, which is inclusive of the return. So your denominator is heavy in this case, whereas in case of add-on rate, the return is calculated on the initial investment or initial borrowing. For issuer borrowing and for investor it is initial investment. So in all cases, your DR for same instrument, DR will always be understated, or it will always understate cost of borrowing for issuer or return for your investor in comparison to AOR, add-on rate. Next, one important thing again, when bond equivalent yield, what was the bond equivalent yield? When yield is presented, that semi-annual bond equivalent yield was when yield is presented with a periodicity of 2. In case of, that was in bonds. What will be the bond equivalent yield? In this case, bond equivalent yield for money market instrument is a money market rate stated on a 365 days. Even if the question says that discount rate or add-on rate are based on 360, we have to convert that into 365 day count convention, and the add-on rate, not the discount rate, will be treated as add-on rate with a 365 day count convention is treated as bond equivalent yield for money market instrument. So if the question gives you a discount rate and says calculate bond equivalent yield, first calculate AOR based on 365 days. Even question says quoted rate is add-on rate with 360 day count convention, convert it into 365 days day count convention, then it will be treated as add-on bond equivalent yield. So different type of questions we may get here. What are the different type of question? Number one, in case of question may give you discount rate in quoted rate in form of discount rate or add-on rate, and they may ask you to calculate either present value or future value. One will be given, second will be required to be calculated. Second, we have already bought something or we have already invested we have already invested in some money market instrument for 91 days, and after 40 days we want to sell it. What should be the selling price? If the quoted rate in the market changes, what will be the new selling price? Third case, one money market instrument is available quoted at the yield is quoted at, in that case, at 360 day count convention on a discount rate basis, whereas in second money market instrument yield is quoted on a 365 days AOR basis. How you are going to compare which is giving higher yield to investor? Third case, calculate bond equivalent yield of a money market instrument, where they will give different 360, 360, 365, 365. 2 will be DR and 2 will be AOR, and then they will say calculate BEY of MMI. Or they may say convert BEY of MMI into a semi-annual bond equivalent yield. So 5 type of questions are there. So what are these questions? Number one, calculate issue price or maturity value, PV or FV, if discount rate is given or add-on rate is given, and day count convention can be 360 or 365 in both cases. Second, resale price. We have bought something, we have invested in some MMI, and now after some day we want to resell it. What will be the, how to calculate resale price? And in that case, if the quoted rate also changes. Comparing two instrument, calculating BEY and converting BEY of MMI into semi-annual bond equivalent yield. So let's go for the first part. Illustration 1, calculate issue price if discount rate is quoted. Generally, it in case when the discount rate is quoted. Quoted rate. If it is a discount rate, if it is AOR, it can be 360 days, it can be 365 days. Day count convention. So in case of discount rate, it is percentage of face value. AOR is percentage of present value. In case discount rate is quoted, generally they will ask you to calculate present values, because future value is already known that this should be the maturity value. What is given? In this case, future value is given that we want a maturity of 5 lakh rupees. We want a maturity of 5 lakh rupees. In this case, future value will be a question mark, that we are investing 20 lakh. What will be the maturity value? In this case, present value will be a question mark. Present value will be a question mark. But here present value will be given 20 lakh got invested, and here also present value 20 lakh got invested. Now, there are different type of instrument which are quoted, generally have a practice. In practice, they are quoted, some are quoted on discount rate basis, some are quoted on AOR basis. So it is the CPs, T-bills and bankers acceptance which are generally quoted on discount rate basis, whereas CDs, repos and market reference rate indexes are quoted on add-on rate, AOR basis. Generally may change, different places have different ways of quotation. So generally this is followed. So for discount rate, we assume it is a CP of 5 lakh, and in case of add-on rate, we assume that it is a CD of 20 lakhs or it's a repo of 20 lakhs. So in this case, they will ask, first case, A bond, A money market instrument, CP, and this is C and this is D. These are CDs. So discount rate. Future value is available. Present value is equals to future value minus future value into DR into days upon year. This is equals to future value 1 minus DR into days upon year. This is equals to, in case of A, present value of A will be equals to 5 lakh 1 minus, we need discount rate, quoted rate. Quoted rate in the market is let's say in all cases it is 6%. We need days for what is the tenure of term to maturity of these bonds. Tenure term to maturity, let's say it is 90 days. In all cases, it is 90 days, let's say. So first bond, bond A, 5 lakh, face value, 1 minus discount rate of 6%, that is 0.06, multiplied by days 90 on 360 days day count convention will give you it is equals to 4,92,500. But if it is of 365 day count convention, it will be 5 lakh multiplied by 1 minus 0.06 multiplied by 91 over 365 day count convention. So this is going to be 0.06 multiplied by 91 upon 90 upon 0.06 into 90 upon 365 minus multiplied by 5 lakh. So answer will be 4,92,603 rupees. In case of future value calculation for bond C, money market instrument C, it will be 20 lakh got invested. This is in case of DR. So in case of add-on rate, AOR rate, your future value is equals to present value 1 plus AOR multiplied by days upon year. So this is going to give you future value of C is equals to 20 lakhs. I think 20 lakh we have taken, 20 lakhs repo. 20 lakh repo is done at a rate of 1 plus 0.06 into 90 on 360 days. Generally repos are of less than, in case of India it is of less smaller tenure, generally 1 day, 2 3 days. There are long-term repos also, but very special, on a very special basis they are used. So let's start with 0.06 multiplied by 90 divided by 360 plus 1 multiplied by 20 lakhs. So maturity value will be equals to 20 lakh 30,000. Second case, if it is a 365 day count convention, D equals to 20 lakhs 1 plus 0.06 multiplied by 90 upon 365 day count convention. Of course, the return will be less. 90 over 365 multiplied by 0.06 plus 1 multiplied by 20 lakhs. It is equals to 20,29,589. The first type of calculation is done. Next part, second type of calculation. Calculate resale price when sold before maturity date and quoted rate changes. So let's assume bond money market instrument C. Money market instrument C. MMI C after 30 days is available for sale. So there is a 60-day period left out of 90. So tenure left is 90 minus 30, that is equals to 60 days. But the quoted rate changes, rate in market changes to, let's say this is a CD, repo you cannot sell. The quoted rate in market changes to, let's say 5.50%. What will happen to this CD? What will be the price at which you will be selling this CD? We know that maturity value of CD will be 20,30,000 after 60 days. After 60 days. So now we can calculate present value equals to shifting this formula. So present value will be equals to future value upon 1 plus new add-on rate multiplied by the add-on rate on the date of valuation upon multiplied by D upon Y, and this is going to give us the present value, the equilibrium value or the fundamental value of this certificate of deposit, which is going to mature into 20,30,000 on an investment of 20 lakh after 90 days. So after 30 days, what will be the price of this CD? We can calculate from this formula. So it will be 20,30,000 divided by 1 plus 0.055 multiplied by 60 over 360 day count convention. Day count convention in case of C, it was 360. So calculation says 0.055 multiplied by 60 divided by 360 plus 1 equals to this, and this is on a reciprocal basis multiplied by 2030 is going to give you 20,11,561. So we have invested on T0 the first day 20 lakh with the expectation that after 90 days we will get a maturity of 20,30,000. But after 30 days, if we are selling this bond, of course the maturity will remain constant, 20,30,000. Now this CD will be sold with a quoted margin of 5.5%, which is the market interest rate. So accordingly, we can calculate the present value as on T30th day. That will become that present value of that 20,30,000, the contracted maturity value as on 30th day will be equals to 20,11,561. So we will be selling this CD at 20,11,561. हमने इन्वेस्ट किया 20 लाख, जो मैच्योर होगा 20,30,000 में, 90 दिन का कॉन्ट्रैक्ट था सीडी जब हमने खरीदी बैंक से. नाउ आफ्टर 30 days एज अ इन्वेस्टर इफ आई वांट टू सेल दिस सीडी टू सम अदर इन्वेस्टर, बैंक से तो ऑलरेडी कॉन्ट्रैक्टेड है कि 20,30,000 मिलेगा ही मिलेगा आफ्टर 60 days. सो व्हाट वी कैन से कि हम इस 20,30,000 जो कि कॉन्ट्रैक्टेड मैच्योरिटी वैल्यू है, फिक्स मैच्योरिटी वैल्यू है, उसकी 30th डे पे क्या प्रेजेंट वैल्यू है वो कैलकुलेट करते हैं. प्रेजेंट वैल्यू यूजिंग दी सिंपल इंटरेस्ट कॉन्सेप्ट. सो सिंपल इंटरेस्ट कॉन्सेप्ट से हमने 20,30,000 को डिस्काउंट कर लिया एट दी quoted rate as on that day, because pricing के लिए उस दिन की rate relevant होगी which is 5.50. it can increase decrease and accordingly we got this value. So अगर investor को अपनी CD किसी और investor को बेचना है तो he is going to sell at 20,11,561. The second type of question is done. Next question, third type of question is comparing a discount rate instrument with a add-on rate instrument. Same tenure, with same tenure, of course same tenure, and these money market instruments are not paying interest, so they are, it's only one investment and one return, one maturity value. So illustration number 3, there is a CP and there is a CD, commercial paper and certificate of deposit, and this is going to be quoted at discount rate of 5% and this is quoted at add-on rate of 5.10%, and the tenure is term to maturity of these instrument is in both cases 90 days. Of course, then only they are comparable. And day count convention is, in this case it is 360 days and in this case it is 365 days. Now investment in which instrument is beneficial to investor? Investment in which instrument is beneficial to investor? Discount rate is 5% and add-on rate is 5.10%. Both are of 90 days, both are having a day count convention of 360 days. In first case, CP is having a day count convention of 360 days, whereas CD is having a day count convention of 365. They are not comparable directly. Either convert discount rate of 5% of CP into add-on rate with a day count convention of 365 days, only then they are comparable, or vice versa. CD's add-on rate to be converted into discount rate with a day count convention of 360 days. So what we are doing is we are converting CP discount rate into add-on rate, equivalent add-on rate with 365 day count convention. How to do this? So let's assume the maturity value, because it's a day count. In case of CP, if discount rate is quoted, now here we have to assume that in case of CP, let the face value is equals to 100, because discount rate are percentage of face value. So we will assume discount rate as face value as 100, not the present value. So if I calculate present value from our formula, it is FB multiplied by 1 minus DR multiplied by days upon year. This is the formula. So we have got present value equals to 100 multiplied by, we can calculate it on 100, 1 lakh, 2 lakh, 10 lakh, any amount will not have any effect, because even on 1 rupee it is going to give the same result. 1 minus DR 0.05 multiplied by 90 over 360. As per the original day count convention and discount rate, we got the present value of this CP 0.05 multiplied by 90 over 360 minus plus 1 multiplied by 100 gives you 98.75. So now we have got present value and future value both for our CP as per the day count convention followed for this 5% day count discount rate. Now converting this these values 98, and at present we are investing 98.75 for 90 days, and we are going to get maturity value of 100. So what will be the add-on rate with these numbers? So calculating add-on rate, the formula for add-on rate is FV minus PV, the return over add-on rate is a percentage of present value multiplied by year over days with a day count periodicity. So this is going to give 100 minus 98.75 over 98.75 multiplied by 365, because the day count convention for comparison we need 365 upon 90 days. So let's see what is the answer. Upon 100, whole upon 100, sorry, not 100, 98.75. Let's do it again. 100 minus 98.75 upon 98.75 multiplied by 365 divided by 90. So equivalent into 100. Into 100. So equivalent add-on rate is equals to 5.1336% per annum. Per annum. Per annum. Of course, multiplied by 100, because we need to calculate this in percentage term, and these are also going to be multiplied by 100 because we need to calculate in the percentage term. So we got what is the add-on equivalent add-on rate with 365 day count convention. It comes to be 5.13%. दो डिस्काउंट रेट क्या दिख रही थी 5%, और एड-ऑन रेट सीडी का कितना दिख रहा था 5.10 5.10. बट जब सीपी का इक्विवेलेंट एड-ऑन रेट विथ 365 डे काउंट कन्वेंशन निकाला तो इट बिकम 5.13%, which is beneficial. So equivalent add-on rate with 365 day count is 5.1336% is greater than add-on rate of 5.10% in with 365 day count. Now we can compare our CP. This was CP and this is our CD. So CP is giving higher return even though the discount rate is less than add-on rate of CD. So directly discount rate and add-on rate are not comparable. Reason 2, first discount rate is a percentage of face value, maturity value, and the count is 360 used here. Whereas CD is having add-on rate is calculated as a percentage of present value and the day count here is 365. So if you want to compare, first DR needs to be converted into add-on rate and with the same day count convention, then only you can compare. And one more thing, what we said that in discount rate is always understated and we can see this. जो फेस वैल्यू पे 5% का डिस्काउंट रेट था, मैच्योरिटी पे 5% का डिस्काउंट रेट था, वो ओरिजिनल इन्वेस्टमेंट पे 5.13% का हो गया. तो डिस्काउंट रेट हमेशा अंडरस्टेटेड रहेगा क्योंकि वो ओवरऑल मैच्योरिटी वैल्यू जो कि रिटर्न मिला के वैल्यू है, बेस वो बन जाता है, तो डिनोमिनेटर बिकम्स हैवी, सो ऑटोमेटिक योर परसेंटेज कम्स डाउन. सो नेक्स्ट, थर्ड टाइप ऑफ क्वेश्चन विच वी मे गेट इज calculating bond equivalent yield for discount rate instrument, discount rate MMI and add-on rate 365 day instrument. अब हमें क्या करना है, bond equivalent yield calculate करनी है. What is a bond equivalent yield of bond equivalent yield of MMI? It is add-on rate on 365 day count convention. When for any money market instrument, your yield is quoted in the form of add-on rate with 365 day count convention. That is your bond equivalent yield of money market instrument. So now let's go for again 4 instruments. I think can we use this? No, we cannot use this. 90 days, 90 days, 90 days, and I think we can use this data. Yes, we have present value, we have future values, we have quoted rates, we have day count conventions also. So yes, let's use this data. Converting quoted rates into bond equivalent yield of money market instrument A, B, C, D. Quoted rate is how much in first all cases? I think it is 6%. 90 days is quoted for all cases. 6%, 6%, 6%. Days are 90, 90, 90. Term to maturity is 90. Quote type in first 2 cases it was discount rate and second 2 cases it is add-on rate. Okay, we have to calculate. So type, it is discount rate, it is add-on rate and add-on rate, because there we have used 20 lakhs. So let's keep the amount same. Or again, amount is not material, in fact. We will take 100. So in this case, we have discount rate, we have days, we have type. Now what we are going to have, if this is a discount rate, what will be the 100, representative 100? The future value will be 100. Present value is question mark. Because here the quoted rate is a percentage of maturity value. Whereas in case of add-on rate, 100 will be your present value, add-on rate is a percentage of investment amount, and future rate is a question mark. Future value is a question mark. So, अब हम क्या calculate करेंगे? What we are going to calculate? We are going to calculate present value. First case, present value. So present value of A is equals to present value of A is equals to FV 100 multiplied by 1 minus discount rate 0.06 multiplied by, okay, day count convention was also there. Day count convention, I think we'll take 360, 365, all four. 360, 365, 360 and 365, and we want to calculate bond equivalent yield of these money market instruments. The best part is, in case of D, we need not to do anything. The D money market instrument is already quoted on an add-on rate basis, already quoted with a day count convention of 365. So its bond equivalent yield is also 6%. Already quoted on an add-on rate basis, already quoted with a 365 day count convention. So it is the bond equivalent yield of this money market instruments. But first let's calculate bond A. So 0.06 multiplied by 90 over 360, we got our present value. 0.06 multiplied by 90 over 360 minus plus 1 multiplied by 100. So the present value will be 98.50, first case. We have got present value, we have got future value for bond A. So bond equivalent yield of money market instrument A will be equals to the return calculated on add-on rate basis. So it is FV minus PV upon PV. So this is an add-on rate. The return calculated as a percentage of investment amount multiplied by 365 upon 90. The periodicity is converted with a day count convention of 365 multiplied by 100, which is equals to 100 minus 98.50 upon 98.50 multiplied by 365 upon 90 multiplied by 100. So we got a bond equivalent yield of 6.176%. This is 6% directly. Even if we calculate, it will come 6%. Next, bond equivalent yield of present value of B. It is 100 multiplied by 1 minus 0.06 multiplied by 90 over 365. 100 is your future value because it's a discount rate, so it will be quoted as a percentage of future value that will be known. So we are calculating present value. This is equals to 98.5205. We have got present value, so let's calculate bond equivalent yield of B. It will be your return, that is 100 minus 98.5205 over investment of 98.5205 multiplied by, this is the formula for bond equivalent yield of money market instrument. So for BEY for A will be equals to how much? 6.176%. In this case, this will be 365 upon 90 multiplied by 100. So we got 100 minus 98.5205 divided by 98.5205 multiplied by 365 divided by 90 multiplied by 100 gives you 6.0903%. So the bond equivalent yield is 6.0903%. Third case C, already add-on rate is there, but on 360 days basis, there is a very small shortcut. Multiply this 6% with 365 and divide it by 360. Automatically, it will change into bond equivalent yield. So, but let's calculate it from the complete process. So here future value is missing. So we have to calculate future value of B. Future value of C is equals to your 100 rupees will be your PV in this case. PV is known. PV 1 plus your add-on rate 0.06 multiplied by 90 over 360. So your future value will be equals to 0.06 multiplied by 90 over 360. These calculations are very easy if you understand how to use day count convention and what is the difference between DR and AOR. Just remember one thing, DR is a percentage of face value, so you will always assume face value as 100 in case of DR. AOR is a percentage of PV, so we will always assume PV as 100 and we will calculate future value. So again back to this, 0.06 multiplied by 90 over 360 plus 1 multiplied by 100. So the maturity value in this case will be 101.50. So now what is the bond equivalent yield of C? It is 101.50 minus 100, and now PV is 100. In this case, FV is equals to 100. This is also FV is equals to 100 because quoted on discount rate basis. Quoted on discount rate basis. In this case, PV is equals to 100 because quoted on AOR basis. Multiplied by 365 over 90 multiplied by 100. Let's see what is the value. The value is minus 100 over 100 multiplied by 365 divided by 90 multiplied by 100 is equals to 6.0833%. We can go for a direct calculation, alternate. In this case, bond equivalent yield, since already based on AOR basis but 360 days, what you can do, 6% multiplied by 365 over 360 days. Let's see what it comes. So 6 multiplied by 365 divided by 360 is again equals to 6.0833%. Same thing. So when it is already quoted on AOR basis, you need to just do the proportionate change for day count convention from 360 to 365. But in case of DR, we have to do all the working, 6.0833%. This is already BEY. Already BEY equals to quoted rate, QR. Why? BEY is already equals to quoted rate. Reason being because it is already AOR rate basis. Quoted rate is based on AOR and 365. So this, in this case, it is AOR is equals to your BEY. Next, last part is the fifth type of question what we can get in money market instrument. Very important topic. For sure, one question should be there out of these 5 style, or there can be some change. So converting BEY of MMI. So BEY of MMI, it's already on 365 days because I'm using BEY and already on AOR basis, and we are converting it into semi-annual bond equivalent yield. Last. So let's say CD quoted at AOR 365 day count convention of 8%. What is semi-annual bond equivalent yield? Semi-annual bond equivalent yield. Now, why we are doing this? Because if we want to compare a money market instrument with a long-term bond, whether which instrument is giving higher yield, there this type of calculation will be required. So AOR on 365 day count is BEY of MMI. Now we want to convert one periodicity into another. In case of CD, periodicity is 365 upon, it's a 91-day CD, let's say. So periodicity will be 365 upon 91, whereas semi-annual bond will have a periodicity of 2. Converting one yield into another, it is 1 plus APR M upon M whole power M should be equals to 1 plus annual percentage rate of N periodicity divided by N periodicity whole power N. We are going to use this formula for converting bond equivalent yield of money market instrument into bond semi-annual bond equivalent yield. So 1 plus 8%, 0.08 divided by periodicity M 365 upon 91 whole power 365 upon 91 is equals to 1 plus APR upon 2 whole power 2. Only one value missing. Let's calculate the left hand side. It is 365 divided by 91 day. Denominator we are having 4.0110 stored memory, 0.08 divided by memory. We got rate as 0.0199 plus 1. This is our value in the bracket. So store 1 or yx power direct power bracket 365 divided by 91 bracket close equals to, so we got 1.0824 equals to 1 plus APR upon 2 whole power 2. So let's calculate the APR, that is your bond semi-annual bond equivalent yield will be equals to, so what we have to do, we have to transfer square as a square root in the left hand side, then minus 1, then multiplied by 2 into 100 gives us 8.0802% per annum. So bond equivalent yield of money market instrument 91-day CD of 8%, if converted into semi-annual bond equivalent yield, it will be 8.0802%. With this, all type of questions, numerical question of money market instrument are covered from study material. Please do practice from study material. Hopefully everyone understood it. Thank you so much.